Okay, let's bring in the former past president of the Chartered Institute of Stockbrokers, Mr. Mike Itegbuji, as he talks to us about how the MPC decision to raise the interest rate to 14% may likely impact on the equities market. Good morning, Mr. Itegbuji.
Good morning, Bolaji.
It's good to have you on the show.
Thank you very much.
First of all, what is your reaction to the decision to raise the interest rate to 14%? Taking a cue from how the market closed yesterday, we saw very impressive numbers coming out from there.
Yeah, but that yesterday's one is not dependent on what happened at the MPC. The MPC decision, well, came as a shock to many people, especially when you consider the fact that a lot of things are depressed in Nigeria. The economy is in recession, and one would have thought that they would have kept the interest rate where it was. But I think they considered the fact that real interest rates were very low relative to the inflationary rate at 16.43, and they felt to encourage savings in the banking sector, they should raise the interest rate so that real interest rate should play more or less a catch-up game. But unfortunately, as far as I'm concerned, I don't think that would do well, because at 14%, they've just raised it by 200 basis points. 14% is still less than the inflationary rate at 16.43. And you know that the interest rates and capital markets go opposite directions. When prices are low, interest rates are high. And when interest rates are high, prices are lower. So for a market that has been struggling to move up with prices, people have been struggling with demand, you have excess of supply, the new regime of interest rates might have a negative impact on the capital market, if you consider it. But, well, we look at the other side that, well, if there's actually increased savings and the banks have more money to lend, maybe the real sector will have some money. Maybe. And if that happens and they're able to perform, then in the long term, it could affect the market positively. But in the short term, I must say that, except for the banking sector that may benefit from these high interest rates, the other sectors of the market might suffer, unless the companies are willing to, instead of going to the bank for high lending rates, they will rather go to the capital market to source for funds in form of equity. If that happens, then this present regime will not adversely affect the market. It will now be a positive gain for the market. But altogether, when you come to think of interest rates and the market, one thing investors should consider is the fact that they should be looking at dividend yield vis-a-vis interest rates. So if, for instance, if somebody buys a share at 1.50 kobo and the company pays a dividend of 30 kobo, that will give a dividend yield of 20%. That 20% is higher than the inflationary rate, and it's even higher than the current interest rate regime. So for us, the issue should be what the investor is looking at. Is the investor looking at capital gains? If you're looking at capital gains, again, that could be terrible because the prices will go the negative side. But if they are looking at dividend yield, then this interest might help them, because at the end of the day, the price will be low, but the dividend they will get will give a higher yield. And once they get a higher yield, then they are better off, because usually for many companies that are performing, their dividend yields outperform interest rates and inflationary rates. So the key issue is for investors to look at those stocks that will give them higher yields in form of dividend, instead of looking at the short-term benefit of capital gain, which is an area for most speculators. And speculators are not too bothered, because in the short term they are looking at, okay, if I can get 5%, 10% within a month or two, I'm better off when I analyze it. For some speculators, they do not really care. But for the long-term investors, if they bother about dividend yield, then they will not bother too much. So for us, I think this present regime will not improve the market.
It will not improve the market, but that doesn't seem to be good news for investors who have been keeping their eyes on this decisions to see if that would help.
Yeah.
But one way I think perhaps investors may also consider is the fact that the central bank mentioned yesterday, the governor of the central bank, that they're trying to see how to attract capital into the economy. So when you raise interest rates, investors out there will come and say, okay, the interest rate is higher, so I would make some money. Do you think that would have any form of impact on the equities?
That will be to the extent that they bring this money into the banking sector. They're going to put them on fixed deposits because they will get higher yield. So when they consider the rates they get from the deposits vis-a-vis what they will get if they were speculating, then it will not have a positive impact on the capital market. A lot of people at a point when interests were very low, when that is interests from fixed deposits were very low, a lot of people put their money out of the banking system and put them in the capital market, looking for shorter term gain, and they did benefit. And that's why you find this sale and purchase for people to take profits in the interim. So when interest rates in the banking sector are higher than what they can get from the capital market, definitely it will, like the CBN governor says, yes, it will attract money into the economy, but not into the capital market. It will rather go to the banking sector.
But that could also help the bank stocks that are quoted.
That will help the bank stocks, but not in the short term. It is at the end of the year. So we'll begin to see the impact on the market at the end of the year 2016.
All right.
And then early in the 2017, when they start bringing their results, we'll see that. But in this short term, between now and the end of the year, not quite will be done.
Thank you so much, Mr. Mike Iteguje, past president of the Chartered Institute of Stockbrokers. We do appreciate your time with us on the program.